Hello and welcome to the Basic Accounting series. This is our fourth video and we are going to continue with the same example that we've been taking from video number 1 to the third video. Now this was the trial balance we prepared in the third session and we are going to take the same example and prepare income statement and balance sheet. Now before we do that, I have a disclaimer here. Since I just took some random examples, random figures and transactions in the first video, and the figures were also very simple, like 1000 rupees purchases, 1000 rupees sales, and then discounts were at 10%, depreciation was at 10%, insurance was 1000 and 1/10 expired. So for simplicity purposes I took very rounded off figures. And now when I'm preparing the income statement or the balance sheet, now this may not look like an ideal income statement or balance sheet, how it should look ideally. Why? Because it does not have all the transactions. We didn't solve a typical accounting problem. I just took some transactions, some common transactions that you come across in accounting problems. So while preparing the income statement and the balance sheet, I realized that maybe I should have taken some more transactions, some other accounting problem. But then I thought, no, I should end what I started. In the first video, the first transaction that we discussed was received cash on account of unearned income of rupees 500. So right from that point, we passed journal entries. Then we posted those entries into T accounts, and then we carried the balances and prepared a trial balance. So let's finish this. Let's put it on the income statement and the balance sheet. This may not be an ideal because we are not solving a proper accounting problem, but at least we'll understand where that first transaction, we'll understand the journey of that transaction from the journal book till the balance sheet or the P&L, wherever it appears. As you can see, unearned revenue of 500 has finally reached its destination. Right from video number 1, I used to say it's a liability, it's a liability. Finally, it has come to the liability side of the balance sheet. So let's just solve it. Let's see what is the profit amount or whether it's a loss. I have no idea. Let's check. So we are posting them now. All the credit side, the credit amounts will either go to the income side. Now this represents, credit side represents the income side and this represents the expenses side. So all the credit items will either go to income statement credit side or they will go to the liabilities section of the balance sheet. Liabilities have a credit balance, incomes have a credit balance. And all the debit side items, the debit column items will either go to the debit side of income statement because they are expenses, or they'll come to the asset section of the balance sheet. So equity of 25,000 credit balance, equity will come here under liabilities. First item, equity or capital. Now there's one more component to the financial statement. It's called statement of equity. So we can prepare a separate statement of equity, but that is needed when you have many adjustments to equity or capital. Like for example, in this, I have not taken dividend. Then we have not taken example of drawings. When the business owner withdraws some money from the business, it is called as drawings. So there are so many transactions that we have not taken. So there is no need of preparing a separate statement of equity. So I'll just equity 25 and then add profits, whatever amount of profit, and we'll take the net figure. If not, then we can prepare a separate statement of equity. Yes, buy balance brought forward will be 25,000. We'll add some profits and then we'll carry forward the balance and the balance will come here. If there are drawings, the account will be debited, drawings of 5,000 rupees. And then we give dividends. We distributed dividends. Dividends means that we have given them the profits. So all those transactions are recorded in statement of equity. But in our example, since we don't have those transactions, we'll simply add the profits. And if it's a loss, we'll subtract it from the equity or capital and then take the net figure. Later, maybe in some other video, we'll solve a proper accounting problem with all adjustments. So let's proceed. Cash, bank. Cash and bank both are current assets. Why current assets? They don't remain fixed throughout the financial year. They keep changing. Furniture is a fixed asset. Next, depreciation is an expense with a debit balance, goes to the income statement. Prepaid insurance is an asset, debit balance, prepaid insurance 900. Why current? Why have I put it under current assets? Because this will get used up within the financial year. It's current in nature, not fixed. Insurance, it's an expense, debit balance, insurance expenses 100. Unearned revenue, it's a liability. Right from the first video we are saying that. 500. Discount received is an income, comes below sales, discount received 100. Discount allowed is an expense, discount allowed 200. Now there is another way of doing this. You either purchases 1000, discount received was 100, so you deduct 100 from purchases and take the net figure 900 here, and sales, instead of recording it at 2000, less discount allowed 200 and take net 1800. You can do that. So either deduct the discount allowed from sales and discount received from purchases and take the net figure, or take them separately, your wish. Next, sales 2000, purchases 1000. So as I said, we can either deduct the discounts if we want. And salaries payable is a liability. We still have to pay the salary. We haven't paid our employees. So salaries payable liability 700. Salaries is an expense. Salary expenses 700. We've recorded it. So now all the items of the trial balance are recorded in the income statement. Now when I go to take the totals, the total of both the sides of my income statement comes to 2100, which means it's a no profit no loss kind of a situation. This is a very rare situation to happen, but since, as I said, I took some random transactions, I had to just explain the journal entries, but later I thought I should continue this example so that students know the journey of that one transaction that you posted in the journal entry till the balance sheet. So now there is no profit, no loss situation. If there was a profit, what should be the scenario? Credit side should be more. The income side is more, expenses is less. So the difference amount will be profit, and this profit will be added here, and so the balance sheet will tally. Now since there is no profit over here, the cash balance remains the same, and here there's no profit added, nothing is deducted. So this becomes 25,000, and then 25,000, this becomes 26,200. This will be your tally figure for balance sheet. Even this total will be 24,400, and then yes, 300, 900, 26,200. The balance sheet will tally at 26,200. But let's make a few changes here. I want you all to know what if there is a profit. Now how to make changes? I'll make a few changes here. Suppose there was one more transaction of sales. Let's say there was one more sales transaction. There was another cash sales made. Now we sold this 2000 worth goods on credit, and then we received the payment from our debtor, and we gave them a discount. Suppose there was one more sales entry made. So for cash account debit 1000 to sales 1000. Now this is an additional entry that I'm making, correct? So what will happen? How will it go to the ledger and then come to the trial balance? Now we'll skip the ledger and we'll see how we can directly post it to the trial balance. Now we've already learned the trick. If you haven't watched the previous videos, please go through those videos. You'll understand this trick. And whenever cash is debited, cash is an asset. So when an asset is debited, its value increases. When an income has a credit balance. Incomes have credit balance. So when income is credited, it will increase. So now sales, if I credit sales, it means this 2000 will become 3000. And I have debited cash, which means this cash of 23,400 will become 24,400. Yes, this will become 24,400, and sales, which was 2000, this will become 3000 because of this one entry. Correct? And this again total will change. Yes, 1000 on debit side because of cash, 1000 on the credit side because of sales. Simple. So once you understand the logic, what to debit and what increases, what to credit, what decreases, you'll get this. Any asset that has a debit balance, if you want to increase it, debit it. Any sales or any income or liability which has actually a credit balance, if it is credited, its balance will increase. If it is debited, its balance will decrease. So here sales is credited. Sales is an income. It has a credit balance. It is credited more with 1000, so increase. Now your total becomes 3100, and this is 1100, 2100, which means there's a difference of 1000. This is your net profit. Now since we have net profit, after making the adjustment, we'll add this profit here. Yes, now your total capital is 26,000, and your cash balance will also change. Now this tally is at 27,200. This again total will be 27,200 and your balance sheet tallies. So the example that we took with 2000 sales, the balance sheet was still tallying, the balance sheet was tallying at 26,200, but there was a situation of no profit, no loss, and that doesn't happen in practical situations also. It's very difficult to have a break even, dot break even. And even in the sums, the accounting problems that you get in the exams, either you'll have losses or some amount of profit. So we just made slight changes in the transactions and we changed the results. Now I won't change the result again to confuse you all, but what if it was a loss? Now here I increased the sales from 2000 to 3000. Suppose the sales was decreased to 1000. Let's say if the sales was just 1000, the total would have been 1100 and this total was 2100. Yes, in that situation we would have come to a point where you were at a loss of 1000. So if it is a loss, then this equity profits are added, because of the profit equity, my ownership will increase. Throughout the year my business earned a profit of 1000. I had brought in 25,000 cash. So now my 25,000 cash or ownership in the company has become 26,000 by adding the profits. But if my business made a loss, who is going to bear that loss? I will bear it. And what I am represented in the business through this amount, that is capital. So if I have to bear the loss, my capital will take that loss and this amount would be deducted if it is a loss. So now I think we're clear. We started with some transactions, posted the journal entries for the same, prepared the T accounts, finally income statement and balance sheet. We've seen a situation, coincidentally a situation which never actually we come across. That's a no profit, no loss kind of a situation in income statement, which we converted into a profit situation and then we tallied the balance sheet. So now you can say that you can start with passing journal entries and you can tally your balance sheets on your own. Now what you need is some extra practice. There are some transactions, as I mentioned, we didn't prepare a statement of equity because we didn't have those transactions. So you can go through the transactions like drawings, when a business owner withdraws money from the business and when dividend is distributed, and go for a problem which has example of a manufacturing company, so that you will have gross profit and then net profit. All direct expenses are first deducted, gross profit calculated, then the indirect expenses deducted, and then the net profit is calculated. So go through those problems. I will also try to make a video on one full problem, accounting problem, with all the possible adjustments that we have missed so far in the examples. But I think on the basis of these 4 videos, you should be able to reach the balance sheet and tally it on your own. We've covered most of the transactions, the difficult ones or the adjustment ones at least. So that's all about this video. Thank you and happy learning.